Iman, how are you? How are you doing with the COVID? Completely out.
It's past and gone. I'm feeling good these days, to be honest with you, mate. I didn't have a bad version of it, so I'm feeling up and dandy and ready to talk to our latest guest.
Awesome. Okay, so we'll get straight to it. Latest guest is probably the biggest European guest we've had on yet. So I'll give a quick overview and then we'll dive in. Someone who kicked off their career at Bain and Commonwealth Capital, MBA from Wharton, was part of Benchmark's European Fund, and then launched ProFounders Capital, was on the 2020 Forbes Midas List for top 25 European VCs. Super impressive track record. Sean, welcome to the show.
Thank you, guys. Thank you for having me. Two quick things. Number one, if this is the biggest guest so far from Europe, you've got a long way to go. So that's exciting because there's a lot of opportunity in front of you still to come. I say that honestly. And second, Iman, I didn't realize you had the vid. So glad to see that you're over it and fine. Hopefully no long COVID for you. And the good news is I don't think you can get it again. So it's a little bit of a hallway pass to be able to go wild.
Well, thank you, Sean. Sean, a question. We haven't said your surname. How do you pronounce your surname properly?
Yes, Seton-Rogers.
Seton-Rogers. All right, thank you.
Awesome. Okay, so as I just touched on lightly, your background, you've got a rock solid track record. Walk us. We don't want to spend too long on the intro because we know you have a ton of knowledge to share and value to add. But if you give us a quick overview of how did you even end up launching ProFounders and a bit about your background.
Yeah, I think I might take you back a few years before that, right? So, I'm not sure if you can even tell by the accent anymore, but I'm mostly from the U.S., although I've been here so long, when I go back, people think I'm putting on a fake British accent at times just because of the intonation in some words. But I moved over here 15 years ago and 3 days to the UK. And it was supposed to be a 1-year opportunity to come hang out and live in London. It's now been 15 years. My kids were born here. They wear ties to school. And I can't make this joke anymore, but sometimes when the Piccadilly line was running late, my wife took an hour and a half to get home because of leaves on the track or whatever it might be. She'd come up to me and say, "You promised me 1 year. You promised me 1 year in London." And I always come back with the quote from John Lennon, which is that life is what happens when you're busy making plans. And so I did come over here originally for 1 year. I was part of Benchmark Capital Europe, which was a fantastic fund investing in tech companies. And then things happened. I was fortunate to have worked very closely with the founder of Bebo, which was an early social networking site that you guys might have used when you were much younger. Bebo was sold to AOL for $850 million. Michael Birch, the founder, obviously lived the entrepreneurial dream, did well, but also had seen, because he lived in California, a different what the West Coast mentality of founders supporting founders does and what it means to the ecosystem. And so together with a few others, we had this crazy idea of trying to bring a little bit of that ethos of one generation of entrepreneurs investing in supporting the next generation to Europe, and to create a fund where all of the investors in the fund, all of the LPs as they're called, were founders. And that's what we did with ProFounders. So the reason we called ourselves ProFounders is not that we're more profound than anyone else, but we were for founders, pro-founders, and all of the money came from entrepreneurs. And the idea was that network could be there to back and support the next generation of entrepreneurs. And so, yeah, it's been almost a decade of doing that. We've tried to remain true to our ethos. We've been fortunate where we've had some fantastic companies, 4 unicorns, if you will, in valuation. And we also have many companies that haven't made it. And that is what happens in the early stage tech world. It's not a guarantee that you're going to build $1 billion company, but if if you're lucky, smart, hard, and everything works out, it can be fantastic.
Very, very interesting early life you had in the space. I just want to double click on something you said. You made a joke about coming to London for a year and then staying, and I just wanted to know, you've got South African heritage, if I'm not mistaken, as well. You've been raised in the US. You now live in London. You invest in Europe. There's a lot going on there. So, what does having that diverse background, having all of those kind of different influences in your life, how does that help you in that journey to get to today?
Yeah. I spent the first number of years of my life, first 10 years in South Africa, then quite a while in different parts of the US as well, and then here now as well. And I think it's quite simple, right? It's about forcing yourself to be open to new experiences. And actually, I think that part of my experience, my background, is critically important in what I do now, investing in tech companies. So this idea of being open and welcoming and inquisitive to new opportunities and new ideas. Everything from, wow, this crazy little nugget of an idea could be something big. Like, let me think about, okay, what if this happens? But also then sort of just the inquisitive to kind of chase stuff down, right? So with Bebo, with Michael, I heard about someone mention this kind of thing at a dinner, and it took kind of 4 connections to be able to track down and meet him. And I think it's just being curious and inquisitive and wanting to learn, dig the next layer, kind of keep going. And I think that in life and that in venture capital and that actually in the startup world are very important.
Yeah. And before we get on to Pro Founders, there's a lot to cover. What are some notable investments that you were seeing as you're an OG of the space? What are some notable investments prior to Pro Founders that you were involved in?
Well, I think, listen, venture funds are more than one person, so I would never dream of taking credit for investments that were done when I was kind of part of a team, right? It's everyone pulling together. So the Venture Market Europe team, clearly Bebo was a fantastic one. MySQL bought by Oracle for $1 billion. Betfair, which is now a $30 billion kind of public company. You can keep going on and on and on. But it is, what's fascinating is and we will come to this. I was thinking back. When I first moved over, if you had $1 billion exit, that was amazing, truly spectacular. Now, what's interesting is that is just a step on the path, right? And people don't get super excited until it's kind of a $10 billion company, which speaks to the broader growing European ecosystem as well.
I like how political you were with your answer. I want to get a little bit under the skin of some of the things that drive your work today, right? So Pro Founders, you say that it's the focus is on anything that leverages technology to transform and improve customer experiences. Can you just deep dive a little bit more around what that focus is and why you focus on that?
Yeah, and I should put this into perspective as well. So when we first set up Pro Founders, we were committed to 2 things, right? Number one is we wanted to be pan-European. We wanted to be able to invest across Europe because we thought and we believe and we know there are great pockets of expertise in all of Europe, right? And so we are probably the only venture fund that in their legal documents has defined Europe as the Eurovision Song Contest countries. So actually because the lawyers were saying, well, what about the European Union? And we thought, what about Switzerland? Never mind thinking about the UK kind of leaving the EU at any time. That wasn't really on the radar. Luckily, the Eurovision Song Contest gave us the biggest kind of definition of Europe. We will not invest into Australia, which recently entered, and we probably won't invest into kind of Turkmenistan, Kazakhstan, Belarus, anything like that, right? So it is more Central and Western Europe where we invest. So that was number one. And number two was we wanted to invest early. So we're passionate about working with founders at the earlier stages of the company's life cycle. And so we set first institutional rounds of capital, which has changed, right? It used to be a £1 million round. Now it's a €3 to €5 million or pound round. And companies raising just inflation in the ecosystem. In the early days, we didn't really define what we would invest into because, frankly, there weren't that many different kinds of businesses out there. And now, the world has exploded. The democratization of the startup world. There's more and more companies being created. There's more and more pools of capital available for founders. The ecosystem has probably grown 5x in the last 10 years by capital flowing into companies and by number of companies created. And so what it means is that you have to really think carefully about where you think the opportunity is and what you care about. And definitely from Pro Founders' perspective, maybe it's because we're curmudgeon-y old bastards, but when things don't work, it pisses us off. We're like, how come this doesn't make sense? Or how come I'm being ripped off on this thing? Or why is there an inefficiency here? And so every company that we meet, we try to understand, okay, how is this company using technology to make faster or better or cheaper or easier something that is painful or annoying for consumers or for businesses and their stakeholders as well. And so that's the way we kind of think about opportunities. And then there's an addendum, which is we also invest in games because games companies don't really fit with that. It has been a fantastic equity returner to people across Europe, everything from Rovio to King to Supercell to Small Giant, where we were investors, all billion-dollar kind of plus exits. So you'd be crazy not to. And we like playing games. So it doesn't really fit with our thesis, but we don't kick ourselves too much about that.
Yeah, awesome. And the various stakeholders and founders, management teams that you've dealt with over the course of your career, as you've developed more experience, how do you now balance your involvement with portfolio companies? So, for example, some VCs have the approach of being very hands-on and saying, look, this is how we add value. Some say, look, we know when to take a step back. We've just bet on the founder. So yeah, how do you manage that, and how do you offer an opinion without causing any conflicts or complications?
Yeah, it's interesting because I'm going to answer it in two different views, if you will. So one is, what do you offer as a venture capital fund? And I call it the full stack versus the thin stack model. And so examples of the full stack model would be Andreessen Horowitz in the US, or EQT Ventures here in Europe, where they have a team of dozens. And so the team is not just the investment professionals. It is people that work on HR, people that work on product market fit, people that can help you in I'm trying to think, how you actually run the teams internally, right? So run workshops on that sort of stuff. Have CFO that can come in and help you set up your finance team and a whole bunch of different things. And then there's the thin stack venture capital model. And the ultimate example of this is Benchmark Capital US, where the team is 5 partners, and that's it. There are no associates, there are no principals, there are no scouts, there is no hiring manager, there is no one else. It is those partners. And there's no one right way to build it. Both models can be incredibly successful. We ourselves personally really enjoy the thin stack model. We think if someone needs help in hiring, go out and find the best hiring expert in that specific industry that can help you with this, as opposed to trying to say, here's our hiring person that you should work with. And those are just different philosophical approaches to how you want to build your fund, and everyone's got a different way of doing it. And frankly, if you have a smaller fund like we do, we purposely operate smaller funds of 50 to 70 million pounds. You actually can't afford to hire 70 people to work for you on doing that sort of stuff. So it's actually self-fulfilling in that respect. So that's one component, I call the full stack versus the thin stack venture model. The other is, your role as an investor, as an investment professional with companies. So when the venture model, when ProFounders first set up, actually, and when I first came over, it was quite standard that if you invested, you took a board seat on the company. And part of that was to show commitment, but also to be involved with the business. And to this day, when we invest, I would say about half the time we end up taking a formal board seat with the company. What we think about actually is we just want to be able to have a direct line of communication with the team. If that means taking a board seat, then so be it. We're happy to. If someone else wants to take a board seat, feel free to. We have no ego about that sort of stuff. We really view our role as investors as being a sounding board, as being an advisor, as being someone that the founder can pick up the phone and speak to when things are going right, when things are going wrong. They just want to chat about something. And so what we want is direct flows of communication with the founders and with the entrepreneurs behind the business. Because actually what we say is that you have to kind of know what you know and know what you don't know as an investor as well. So I have not been a direct operator of a company, and I know that. And so I'm not going to tell you, what's the best approach to firing someone, or what's your specific business partnership, whether you should sign that deal or not. You're the founder, you're the entrepreneur, you're the one that makes the decision. You know what I can do? However, I've worked with many, many companies in my life, and I can help you bring a more holistic view. I can help you step back and understand, where are we in the company building process and where do we need to go? So the way I think about it is, for every business, you have limited resources, people, money, and time. And you need to take those resources and you need to invest them to generate traction and proof points for the business, and also to be able to raise again. Because remember, once you start fundraising, you're kind of on the path of raising more money because you're investing ahead of revenues coming through. And so I'm going to help you think through decisions that you need to make. So you've got, you've got people, money, and time. And if you decide you want to invest further into the product itself, that means you don't have as many resources to put into marketing. If you decide you're going to double down on marketing, that means you're not going to have additional resources to develop business partnerships. If you decide to put money into business partnerships, you can't invest in opening up new geographies. And everything in life is a trade-off. And I want to help you make those trade-offs. I want to help you think through them so you can be best positioned to be able to raise capital again. The new analogy I've been using is you're sitting at the poker table, at the blackjack table, and you've got a certain number of chips in front of you, right? Which is your people, your money, and your time. You got to start placing those chips in different ways, and we can help you do it because we've gambled quite a bit, and we can bring a different viewpoint to that. In the end, you're the one putting the chips out. You're making the bets. You bear the consequences of it, but we can help you do that. So hopefully that was a very long-winded answer to a short question. But
you picked up on a whole bunch of points that we'll come back to around the democratization in the space, what sort of the different types of players in the market look like, which I want to come back to. But I want to take you on one of the points that you raised towards the end, which is how you actually support founding teams and helping them raise again, etc., and whether board advice necessarily needs to come from you sitting on a board seat or not. And you've got something called Provision Community. And I just want to understand a little bit more about what that is and how it fits into the narrative you just said about supporting founders and supporting that growth element. Because I think that example will help articulate quite well what it is that you just explained.
Yeah, and I must say we have gone a little bit mad on the capital P, capital R, capital O in the last couple of years. So we have many pro initiatives, as we call them. It's our program, if you get it, with pro founders. So we have pro angels, where we work with angel investors. We help work with their portfolio. We help connect them with companies that are too early for us. We meet some of the companies before they'd even fundraise. We help them network with each other and share ideas to engage with the angel community. We have Provision, which is our way of demystifying venture capital, because I think a lot of it is still a black box about how VCs think, how they assess founders, how they assess markets, how they assess how a company's doing. And so we record a bi-weekly video podcast, sort of YouTube series, where we take questions, certain themes, and then questions from the audience, and we try to give insight into how we think about things. But actually, the most beneficial one for our companies is our profit, if you call it, where we work with companies kind of quite about 6 months after we invest, because that's actually generally the point where you've now had a chance to place a few chips on the table. You're starting to learn about what's working and what's not working. And we try to put ourselves in a position to think about actually writing the next round fundraising presentation, the next round deck, to understand what we think we've proved so far, what we need to prove over the next 6 months before we properly go to market, and start thinking through who the right investors could be at the next stage. Because that's honestly, if you think about where VC can add value, fundraising is where we should over-deliver, right? I mean, that's what we know. That's what we do. That's who we chat with on a regular basis. I probably have 10 calls a week with other VCs to gossip and talk about things. And so, I can write a fundraising deck with my eyes closed, in my sleep, whatever you want to say, right? And so we should help founders be in a position to be able to fundraise. But it's not actually the deck, right? What it is, it's the meat of the deck. And the meat of the deck is, what have you shown so far, and what do you need to prove? How are you going to take this next round of capital and invest it into the company to continue to grow? So many pros, Provision, Profit, Pro Angels, our program. We have promoters who work with us in different territories, kind of talking about the fund. So we've actually spent hours in front of the dictionary typing in, looking at words that begin with PRO, trying to understand what else we can do with it.
You better trademark some of those, Sean, pretty soon before people start.
It's a good point. We've never even thought about it. Okay, good. I'll get on it.
So VCs typically, they love to invest in founders who can tell a good story. And I've actually written an article on our website about how the founder of Nikola and Adam Newman of WeWork and these people also told a good story. So how can investors mitigate such risk? How can you really assess beyond the, track record? What kind of person are they? Their character, sort of tonality and body language when they're pitching. Beyond these things, is there anything in particular that you've picked up along your journey to assess and mitigate such risk?
Yeah, it's so listen, the ability to tell a story, craft a story is incredibly important for a founder, right? And that doesn't mean it's about, being a complete salesperson, because let me tell you, Mark Zuckerberg in the early days was not a salesperson kind of person, right? But he had a vision, he had a passion, and that would come across when he spoke about the business, right? And so the ability to get in front of investors and sell them, not as in the used car salesman way, but be able to really talk to them about why you think this is a huge opportunity and what the milestones are is incredibly important and critical to a company's success, without a doubt. What I find interesting is you bring up Nikola or Theranos or some of these others that have been bust. I think what's actually reassuring about that is we can name them, because there actually aren't that many of these ones where you look at it and you pull back the curtain for the Wizard of Oz and it's not a big, it's not a big mystical creature kind of there. And so actually I think it's quite probably good that those stories are quite high profile, because there aren't that many of them, right? If it happened every day, it'd be quite different. But where we invest, we at times are investing in slideware, vaporware. We are investing in a team and a vision. And so have there been times where we've invested and the company hasn't been able to actually bring to market or build or generate the traction that we thought they could? Absolutely. But that is the nature of where we invest, because we are really investing in a team and a vision. At the stage after us, they're investing in a team and some early inkling from a product. Where I think it gets tricky is at the later stages. And that's why the diligence process also gets more in depth. I remember when Get Your Guide was raising from KKR, who's a later stage fund. At some point, the CEO of Get Your Guide emailed me. He said, you're not going to believe this. There are kind of 45 people on the deal team kind of email, master distribution list. And it's the finance team, the legal team, the HR team there to verify all employment contracts are correct and do the checks on all the investors and their background. I mean, it was kind of crazy. And so I'm always shocked when people are able to pull off these scams, the wrong word, but able to pull the wool over people's eyes, because frankly, I've seen these later stage funds when they invest, and SoftBank Vision Fund invested into Get Your Guide, and I mean, they do proper analysis. I mean, these people aren't joking around. I mean, they are really digging into stuff, right? They only use PwC as an external consultant to verify every single number that you've ever kind of presented and query you on this and why that doesn't match up, and do technical assessment of your HR, of your finance and reporting systems. I mean, they really get involved. So I think it's very rare that actually happens. And I think there are a lot of checks and balances in place. And part of it is next round financing. I mean, I think the philosophy that an internal investors shouldn't continue to back companies and bringing in new investors, I think works really well. And it is a check and balance on the overall ecosystem.
So you mentioned a couple of cool things. So I'm going to challenge you on one of the things you did say, though. So around the diligence that happens behind some of these later stage companies, I feel that a lot of the time when we do that type of analysis, when we do that type of due diligence, you are trying to find a middle ground with the person you're trying to either buy or sell. And a lot of that is negotiation around the commercial aspects of the business. A lot of the time that gets lost when we're talking about valuations and multiples that are just ridiculously sky high, because part of this work is to benchmark multiples against what's happening in the industry. So I think a part of that is self-fulfilling, in the sense that although all of our analysis is telling us this tech business is going to do amazingly in the future, what have all the other tech businesses in this space sold for? Okay, take that multiple, shave a little bit off and set it for that. I think that's ultimately what it comes down to. And in the negotiation process, having been part of it, I see that often. Let me just take that discussion in a sort of semi-different direction. You guys, you mentioned earlier you're sort of on the smaller side. What's the impact of democratization having on your business, if any, and is it helping? And what I mean by that is you've got like these rolling funds coming in, you've got the angel list syndicates that have been around for a little while.
Crowdfunding,
Crowdfunding,
EIS
exactly.
programs for angel investors.
Super angels around. So well, firstly, has that impacted valuations in the things that you've seen? And secondly, are you seeing any impact on the sort of companies that you are able to target because the space is filling up so quickly?
So it's a great question because the raw numbers say the market has grown 4x in 10 years, right? Amount of capital invested, amount of capital raised, number of companies being created. If you ever look at the State of European Tech report that comes out with Slush and Atomico every year, you get the data behind what's going on, right? It's a fantastic report. I encourage everyone to go take a look at it and give it a read. There's definitely a lot more capital available. And actually, that situation is exacerbated at the early stages. So I would say if you looked at it overall, there's probably 3x the capital at the later stages, but 5x the capital at the earlier stages for companies. So where we invest, without a doubt, there's a lot more competition. And so has that impacted prices? Depending on what you think about supply or demand, the number of companies has gone up. The amount of capital after those companies has gone up a lot more. And so what that means is undoubtedly valuations have increased the last few years. And they've increased as in normally the amount that you pay now is double digits as opposed to a single digit in valuation for a business. But also it's inflation in the amount of capital that companies raise then. So companies that 5 years ago would raise 1.5 million pounds are now raising 2.5 million pounds at a higher valuation. So the dilution is about the same for the founders, but they've got a lot more money to invest. And so, yes, without a doubt, valuation prices going up. And self-servingly, has that made our job harder? Hell yeah. There's a lot more competition out there for the founders. We're not the only game in town now. There's not 12 venture funds in London that you can go speak to. There are super angels. You can do a crowdfunding round. You can go an angel list syndicate. You can go talk to funds in the US that now can Zoom call with you and feel comfortable investing into someone in Europe. So our job is harder. We need to get in front of companies sooner. We need to pitch harder. We got to really sell people on why we're great. And we actually looked at this recently. We looked at our win rate over the last few years, as in a deal that you want to do. And it's gone down a little bit, right? Because there's just more and more opportunities and funds out there. And a lot of times we hold a firm line on price as well. So we don't get into a deal we want to get into. And that's a separate question about whether we should hold such a tough line on price or just, be price takers as opposed to price makers. But listen, who's the net beneficiary of all of this? It's the founders. And so great. If that means that they're taking less dilution by, to get to the end of the road, that's okay. That's, I can't complain. That's fantastic. People complain about footballers' salaries and so forth, sports people's salaries in the US. Better it goes to them than the owners. So go ahead. Yeah, absolutely.
Yeah. And on the topic of democratization, so in the US, and I think increasingly in Europe, slowly and gradually, investors they're seeing more rounds with, let's say, several $200,000 checks from rolling funds and super angels that you touched on with no board seats. So some founders prefer the independent investor instead of a traditional board. Do you anticipate long term, is this the end of the board as we know it? And what value do some of these boards add really from your experience and what you've seen generally?
I don't see the end of a board, if you will, because I think, frankly, especially as companies grow, governance becomes incredibly important to them. And so, the reason we do have boards is that they serve a role, right? They create a structure around which people can get together. They ensure the company is doing, ticking the right boxes and doing accounts and things aren't going well, bearing responsibility for it as well. Actually, that's a big one. And that's honestly one I should elaborate on a little bit. So part of the biggest job of board is actually to ensure all stakeholders are taken care of, right? And so what people don't want from governance perspective is bad players in the industry. And if companies just run into a wall and leave people that they owe money and employees high and dry, that's really bad. So what a board does is a board bears responsibility for that, right? So I have thankfully never been on the board of a company that's gone into administration or bankruptcy, but we have at ProFounders. And, when it forces us that if things aren't going well to have the conversation with the founders and say, okay, you know what, we don't have a 6-month operating plan here. We will run out of cash in 4 months if we continue it is. We need to take steps now. We are trading insolvently. We need to understand, look around the table, understand that we bear responsibility for this. And those conversations are fantastic to have because they actually force everyone to say, is this the right opportunity? Is it worth us putting more money in? Is it worth another year of everyone's time? So I think it's critical to do that. And so I think boards are good. And actually, if you look where boards go wrong, it's because they're too insidery, right? If you look at it, it's kind of it's in the U.S. It's the whole kind of the CEO and chairman of the board is one role, and in the UK, in Europe, that's not as much. And I think it's actually very important. Bringing in people outside of the business, outside of the shareholder base, we still like doing that. We used to do it as we want someone who's an experienced player in the industry to come in and we get their time. But actually, I think it's critical to have them on board as just an independent representative of stakeholders, all stakeholders in the company. So I'm actually a passionate believer in boards, even at the early stage, a 3-person board, one investor, two founders. A is the mechanism for us to communicate, a forcing function for us to communicate, but also to ensure shared responsibility for the outcome of the business.
I guess that's quite interesting because I don't know if you hear the same line from different venture funds. I get that there's different views on this space, and I wonder if that's to do with the democratization and the fact that you've got so much capital flowing in from people that aren't your traditional and typical VCs. Let me move the conversation on if that's okay. We're about halfway through now, and I just want to know a bit more about some of the companies you've backed and what are the things that they had in common, right? So what are the things you look for when you're investing in these companies? There's some quite interesting names here. You've got Get Your Guide, TweetDeck, Lulu, Easy Car. You've exited from players like Roll Up Media,
Made.com, One Fine Day.
Yeah. Mention the bigger exits, not the smaller exits, please, Iman. Come on, help me out here.
No, it's good. The line you pull between the commonalities between the smaller and the larger exits would be quite interesting to understand.
Yeah, it's. Listen, our goal is to invest in companies, get an ownership stake, and then eventually achieve liquidity in the business. Right. Our job is to return capital back to investors, and I think sometimes investors forget that we're in the money management business. Our job is to make money for our investors, and we do that in a different way than other people do. Clearly investing in Tesla stock only would have been fantastic for the last 5 years. So everything we're doing is completely wrong.
Hindsight's a beautiful thing.
Yeah, it's quite a run. So when we invest in businesses, we're trying to create a portfolio here. Of slightly earlier, slightly later stage, geographic dispersion, different types of businesses as well. Because we've told our investors, we are generalist investors, right? Obviously, the common thesis of backing businesses that fix broken customer experiences. But we are generalists that want to create a portfolio set where we think we can get 5 to 6 companies that could each potentially return the fund, right? We go into every investment saying this company could return the fund, but we'll get 4 to 5 to 6 that actually will generate a fund returner, so to speak. And the difference between a good venture fund and a great venture fund is whether you get 1 or 2 or 3 and 4. And that's what it comes down to, honestly. And so we go into every company with the belief it can be absolutely massive. I think what they all have in common is coming back to what we spoke about earlier, a founder that is able to project really well, able to fundraise, and able to do 2 things. Number 1, talk about the big goal, where they're headed, but be able to also at the same time lay out the next 6-month steps, tactically, strategically where I want to be in a few years, and tactically what am I going to do over the next 6 months. And that's a hard balance to strike because we have founders that we back that it turned out were fantastic at the big vision, but actually how you delivered on that, how you took the company from 0 to 1, to quote from Peter Thiel a little bit, was really hard. Or people that could do the short-term stuff but couldn't fundraise because they couldn't present the big vision, the huge opportunity, why this is going to not change the world, but why this could be an absolutely massive opportunity. And so looking back, founders that can thread the needle between both do insanely well. And then I think the other one is, sometimes we forget big market opportunity. Big market opportunity is critically important. We invest in companies where great founders, really strong growth. But the ability to build a multi-billion-dollar company, eventually people just said, I don't think so. Doesn't sound big enough. Doesn't feel big enough. And it kind of falls apart because they can't fundraise. And so I think maybe we'll come to it in a minute, but I think it is worth chatting about how funds work, how venture funds work, and why unicorns are so important. And so I don't know if you want to indulge me now, but I have a little spiel, if you will, a little talk, I got 2 minutes on understanding why unicorns are so important, why people are fixated on it, right? So can I give you the simple math? Is that okay?
Please.
Okay. So I was doing a round number. So if you have a $100 million fund to invest, you go out and you pitch your investors and you say, I'm going to make you 3 to 4 times your money. So I've got to create $300 million now in equity value. So just keep that in the back of your mind. So 100 million. Guess what? There's fees and salaries and so forth, which means I've actually, of that 100, I've only got 85 to invest in companies, right? So I got to take that 85, got to invest in companies. I'll do it in, say, 20 companies. But the reality is 10 of those companies are going to go bust. So 10 of those companies go bust means I've actually only got 45, 50 million that actually goes into the companies that are doing well. So I have 50 million in companies. I need to turn that into 300 million in return at the end of the day. And so even factually of those 10, some of them will only get our money back. It's actually only 5 that I've got to really turn into 300 million. And so when I invest, I get a 10% ownership stake in the company. So that 3 million actually needs to be 3 billion in value to get my 10% being worth 300 million. So 5 companies, 3 billion in value. And so that's just, and then the next round, by the way, the next investor is investing at a 30, 40 million valuation. He's got to do the same thing. And what it means, it's very skewed to outliers, to the power law kind of returns. And we need those really, really big exits. And that's why people say unicorns, decacorns, whatever the other term might be. You need those big ones to be able to make up for all the other ones that don't work out. And so huge opportunities, strong teams, that's what we need. That's what we care about. So I think all the ones that have worked out have that thread running through them. I would say the ones that didn't work out also had that thread running through them, we believed at the time. But we were wrong. Either the timing wasn't right, the opportunity never arose, we couldn't fundraise, whatever it might be. But there's many reasons, there's a few reasons why a company can be successful. There's many reasons why it can go wrong along the path.
Yeah, it's a great way for you to really make it clear for anyone that thinks being a VC is easy, especially in addition to everything you've said. The results usually, you don't know the results 7 to 10 years in. So I think, it's a great way to put it. Sort of shifting gears, what are some frameworks or mental models, if you will, that you use as an investor that sort of helps you with better decision making, or just generally, especially in the early stages with imperfect data? I mean, you've touched on a few points already, but is there any frameworks that are your sort of go-to to really help you in that process?
Yeah. So we have 2 that well, I suppose 3 that we use internally, but they're kind of intertwined. So the first is we have our assessment framework that we use with businesses, right? We call it our traffic light framework, which we look at a business, and we try to assess the team, the market, the traction, the economics, and the team, market, traction, economics, and the fundraising plan sort of ask that they've got right now, right? So team, do we think this team is has rock stars on it? Market, do we think it's a huge market opportunity? Traction, just to get a sense of what they've shown so far to date, right? The big one for us there is cadence speed, iteration speed. Can they show us they do things quickly? Competitive landscape to understand what's going on. And then the fundraise asked, because we need to ensure that with every round of financing, they've got enough time, enough money to be able to generate the proof points that they need, right? So we try to look at it, and we do red, orange, red, amber, red, whatever you want to call it, like traffic lights. Red, orange, green. What am I saying? Green, orange, red. And so ideally everything would be green. I don't think we ever invest in a company where everything is green, because guess what? These are early stage companies. There are going to be things that you're unsure about. If we get a red on anything, for us, that's sort of terminal. We can't advance if there's a red. And if there's more than kind of 1 or 2 oranges, that's an issue, right? We need to really understand what it is that we're going into. So that's the one sort of framework that we use. The other one is more of a joke, but we try to think about founders, and we have a founder who will remain nameless. That is in our mind the best founder we've ever backed, and we use that person's initials, and we call it those initials scale. And weirdly, that founder is 10 of those units as opposed to 1. So it's not a 0 to 1, it's a 0 to 10. And so that person is a 10 on their scale. And we try to think about teams. We say, okay, where do they kind of rank on that scale, right? And you shouldn't really be backing anyone that's not an 8, because you got to put them in front of next round investors, and they need to be able to, if things are going well, be able to present the story, the vision, and raise capital. And let me tell you, if you're a good fundraiser, you can solve for a lot of problems along the way. It gives you time. It gives you fuck ups along the way. It gives you a chance to make mistakes if you have more capital, right? So anyway, there's the traffic lights, and then there's the X person scale that we use. And I won't use the initials. I don't want to put it out there. I don't want to give the person too much of an ego or take away from any other founder that we use. So it's an internal only scale, that one.
You've given golden nuggets of information for listeners that want to pitch to you. What about GPs? What about people that want to set up funds? What advice would you give to GPs for doing what you've done?
Yeah, I suppose think about why you're doing it. And so listen, I always joke with people, venture is a great way to get rich slowly. And I think, Cyrus, you touched on it a while ago, where you don't really know until 7 years, 8 years, 9 years, unless you're super lucky, and well done if you are, whether or not you want to be doing this actually. And so it's fascinating, because if you look at backgrounds to investors, there's no one background, right? If you look, Mike Moritz at Sequoia, who is without doubt one of the greatest VCs of all time, was a reporter before he became a VC. And others have worked in equities and trading stocks, and others have come from consulting. Some come from, definitely a lot of people come from setting up startups themselves. But it is interesting. One of the things that founders find when they become VCs is they're not in control. I am not an operator at a company. I can give all the advice I want. I am a psychologist. I am someone with a stick and a carrot. I can't beat the founders to get them to do what I want. I can kind of hold up a carrot, and I can yell at them a little bit, but not really, in a nice, courteous way. But can't do it myself. And so a lot of founders become investors, and they say, Jesus Christ, this is infuriating. Why won't they do what I told them to do? And it drives them nuts. Others are fantastic investors and really do an amazing job. So there's no one right kind of path. I mean, I think for GPs though, it's know why you want to do it. Know it's going to take a long time, but then also think about how you're going to stand out in the crowd. Because as we touched on earlier, there's a lot of capital available for companies now, and you have to really think about what you bring to the table that's going to be unique or different for founders. Why would they choose you? Why do they want to work with you? And so, listen, it's obviously it's a great job. I am privileged to do what I do. I wake up excited. Every single day, but I never leave home anymore. So every day feels kind of the same. So yes, I do wake up excited, but it's always for I suppose in the same environment nowadays.
Yeah. And I love what you said earlier around that you said you don't have operating experience, and you don't try to interfere with advice or anything around operating to founders, whereas some VCs do. And I think this self-awareness and rationality has been probably a huge part. It's been paramount to your success from an outsider's point of view anyway. Shifting gears, this is something we ask most guests, but I think there's probably not a better person to ask than yourself. My view has always, and you may hate me for this, Sean, my view has always been, compared to the US and China, Europe has always been sort of lagging behind. And we're not talking about, of course, funding amounts and rounds and exits, etc., because per capita, I'm talking more around per capita and relative. But how can Europe foster more innovation and attract more funding? What are your views on just the future? And if any, feel free to shut me down. Maybe in your view, things are absolutely great in Europe.
It's come a long way. It's come a really long way. If you look back to 2005 when I first came to Europe, the ecosystem was tiny. There was no Berlin. There were no companies in Berlin. Berlin was not a startup hub at all. And think about now, when you go there, you can't, you throw a ball and you'll kind of hit 20 people who work in startups and venture and investments and so forth. So I think, listen, it's not the US, but it's advancing rapidly across every single metric that you look at. Europe is making really strong strides. There are certain sectors where I think Europe is incredibly well positioned. So listen, the web I think has moved, broadly speaking, and clearly AI and so forth. Tech has moved away from kind of the pure infrastructure layer infrastructure layer. And it's much more about what you do with that infrastructure layer, about the creative design-led services and products you build on top of that. And what that means, it's no longer about having the most number of techies. And by the way, I'm giving massive discredit to DeepMind and AI and where Europe is in that. So I don't mean to do that, because actually, obviously, Europe's fantastic at core research as well. But what this does mean, I think, is that having expertise in an industry is more important. And I think there are certain sectors where Europe has deep roots and deep experience, and therefore has created many companies. So I'll give you an example. Music. Think about music. So Europe has been leading in music for years, right? And by the way, it's a very Western cultural viewpoint, so please ignore it if you're in China, happen to listen to this. I'm sure there's great Chinese musicians throughout history. But if you look at Western kind of Western culture, Beethoven, Mozart, the Beatles, the Rolling Stones, etc., have come out of Europe. Europe's created a lot of these kind of industries, and so these bands and music and so forth. And so, is it a surprise Spotify came out of Europe? Absolutely not. Is it a surprise Deezer came out of Europe? Absolutely not. This is where the labels are. This is where the musicians are. I'm not surprised. If you think about fashion, London, Paris, Milan have been the fashion epicenters for 70 years now. Yeah, is it a shock Farfetch and Von Privé and Net-a-Porter and others came out of Europe? No, these are innovative fashion models that the U.S. have cloned. I'm going to go on. I'm going to say, if you look at finance, right, the Swiss banking system is what we use. London is the epicenter. Is it a shock Revolut and N26 created the neobank ahead of the U.S.? No, because this is where there was deep cultural knowledge in sectors. And I say education, finance, music, fashion, and others. This is where things are happening. So I am incredibly bullish on Europe. Now I have to be. I have chosen to build a career here. So this is very self-serving for me to say this. And this is what I tell LPs when they ask about Europe. Absolutely, this is a good place to be. And then the other thing I say is that, Cyrus, you said compared to the US, compared to America. But let me tell you, when people sit there in New York, they have the exact same worries that we do. They go, oh my God, we're not San Francisco. What are we going to do? Is it bad that we're not as good? And like, you know what? It's okay. Like, we're not San Francisco. And, San Francisco has its own issues right now. Rents and people are leaving and so forth. So it's okay. Let's think about where we're going to be as opposed to where we've come from.
I always push back on Cyrus when he says that, because I most of the work I do is in energy, and the energy space in Europe is so far ahead of the US. Now, put Tesla aside because that's a recent bubble, but generally looking at grid balancing and all of the renewable side stuff, it's just way ahead of the rest of the world. Yeah.
By the way, this so it does it touched on something, which is people go, oh God, Europe's socialist, nothing happens there. And the reason Europe's ahead in some of these things, because the government invests in infrastructure here, right? So the US, they're like, no, we can't spend any money. Government's bad. Let's start with money. Therefore, government has poor service delivery. Therefore, look, government is bad. We're not going to invest in it. And so if you look at Europe, Germany as well, right? The government-led investment in solar and wind and other things has created a meaningful ecosystem to build from, right? And so that government investment has allowed entrepreneurial success in these sectors as well.
Absolutely. It's the floating off the government support that will really tell us to what extent these companies are going to thrive. And it looks like they are. You just had Octopus Energy raise at a $2 billion valuation. So these companies are doing really, really well. If people aren't watching this and they're listening, there's a poster behind Sean's head, which is it's the famous Jordan poster of him from dunking from the free throw line. And just before we started recording, Sean said that he's a massive sneakerhead, so we have to pick up on this. What are your favorite sneakers? And I know you're obviously going to say Jordans, but do you have a specific Jordan that is your favorite sneaker?
Absolutely, I do. So I have, I have what I have, like what I own, and then what I want. And so I'm going old school classic. My favorite, one that I have. So it's the Air Jordan 1, broadly speaking, right? I think it's the original. It's the classic. It's fantastic. I think I have 6 pairs. My favorite is actually the bread, so the original black and red. Nothing beats it, right? I mean, it's the iconic. It is the one. It is. No, those are 2s actually. I think I haven't actually looked. I wasn't sure if that's 86 or 87 in the poster. But actually, my the one that I want to buy, and I just can't convince my wife that I'm allowed to spend that much money. But I think the Air Jordan 11s which is the one that was inspired by being able to wear out to formal dinner wear. So it's got the kind of the gloss finish along it. So the Jordan 11s in black and red, the breads, are what I really want. They're about 400 quid, and my wife, every time I threaten to buy them, my wife says you're absolutely insane to do that. So that is my ultimate one to get. So someday, I'll decide to splurge. What about you guys? Let me ask. Let me flip it around.
I've actually got the Jordan 11, but me and Iman, we caught the end of the Jordans. We are more, of course, we're millennials, so more into the Yeezys. That was never your thing.
Of course. I can appreciate it, and I do. I'll tell a funny story very quickly. I was on the tube. So it's about a year ago because you could be on the tube. It was a Friday night. My wife and I were going to some event in town, and a guy came on in some really lovely Yeezys, like perfect white, and sits down. This woman kind of stands in, and steps on top of them in her high heels, and just leaves a big black mark.
Ooh.
And she was like, "Oh, I'm sorry," and he's like. And you could just see he started just panicking and like really freaking out. And he couldn't say anything because she was like, "Oh, I'm really sorry I stepped in your shoes." And he was like, "It's okay." I could just see his mind kind of melting. And I remember I looked over from across him. I was like, and he looks back. Oh, it doesn't work because it's a podcast, so you're not seeing it. But I mean, we had this mind meld over sneakers where I was like, "Dude, I get it. I can't believe that just happened." And he's like, "I can't believe it." And we literally were like communicating verbally back and forth with it. Although I didn't want to tell him, probably shouldn't have worn those out, right? You got to be smart about it. So if I had those Jordan 11s, I'd only wear them indoors, right? If I was going out, I'd probably have a ridiculous backpack with another pair of sneakers to change into. But I can appreciate.
So my favorite one, in answer to your question, is the Air Yeezys, the Nike Air Yeezys before he signed the Adidas deal.
Yeah,
the pure platinums, and they've got like that little lace that is similar to the Jordan style, which is quite cool. The Jordans in that picture, are they threes? I think they're the threes were designed after those or just before that. I don't know.
The problem is they're completely blurred out, so I actually can't quite tell. So they've kind of pixelated it. So I want to say that the famous slam dunk was 80.
It was 88.
88, which would be 84s. Could that be 4 then? 85, 86, 87, 88? Maybe. So yeah, it must be Air Jordan 4s then. It's good fun. I buy and sell. I just got some new Air Force Ones that I got the cop on Tuesday for the Air Force One ray guns. So it was last week, so they arrived this week. Clearly, it adds to the collection. Although I honestly I wear this. So I feel I'm hip and cool because I collect sneakers. I'm also wearing a pair of slippers now because I don't leave home. I like to keep my feet warm. So I really do alternate between two extremes. Bunch of sneakers downstairs and then slippers on my feet as an old man as I walk around the house.
Awesome. I don't want to show my slippers because it'll probably change the viewer's perspective on the brand. But hey, just before we wrap up, Sean, are there any books that have sort of helped you generally, not just with being an investor, but generally just with life? Are there any books that have helped you along the way?
Yeah, I mean, I love science fiction, broadly speaking. So I love it because it's to me, someone like Neil Stephenson, who's written many books, his ability to kind of forecast the world, right? He wrote books in '99 about digital currencies. He created the term avatar back in '84 with one of his books. Like, I think that stuff is just fascinating to see how people think the world will evolve. Although, he's getting even more and more dystopian as things go on, which has me a little bit worried about the future of humanity, right? But actually, as far as business books go, I maybe it sounds ridiculous because I know a lot of people love it and swear by them. I think they're mostly drivel. I look at them like, okay, it's you could summarize them in like 5 words, and then they find 50 examples to back it up. So I don't read business books. I kind of live that in real life. That said, the book that I always found most impactful is a book called The Psychology of Persuasion by Robert Cialdini, and it's Cialdini, Robert Cialdini. And what it is, it's about how our minds work and how we're persuaded to do something. And so it's fascinating. It's little tidbits like creating a permission structure or reciprocity, right? So if when you go to the store and they give you a little free sample, they're not doing that because they're nice. They're doing it because the moment you take it, you feel like you owe someone something. You do. Psychologically, if someone's giving us something, we owe them something. And so it just teaches us to employ those, but B, to be aware of those as well, right? And even things like the reason, for example, that when people, if you look at a lot of programs around losing weight, stopping smoking, et cetera, they get you to publicly declare something. Public declaration is super important because once you've said something to others, it's hard to go back. We want to be consistent. We need consistency in our lives. It's the same reason why in politics, if someone's voted for someone, denigrating if someone voted for Trump, denigrating Trump doesn't convince them because consistency in their mind, they can't go back and admit they were wrong, right? And so, fascinating examples. One of the ones they had was they had kids go around a neighborhood one time and say, do you want to pledge to save kids' lives and people should slow down? And of course, everyone's going to go, sure, I'll sign that sheet of paper. And they went to every other house. Then they went to every single house and they said, can we put this massive sign on your front lawn with bright lights that says slow down? Because obviously you care about saving lives. And people who had signed the sheet of paper, 50% of them would say, sure, go ahead, put up the ugliest thing ever. Because they literally internally couldn't say, no, don't put that crazy thing on my front lawn, because they needed to be consistent, right? And so it talks about, I think, the 6 different mechanisms that our minds use. And I just found it absolutely fascinating just to think about the way we operate in life. So the psychology of persuasion.
Yeah, Robert Cialdini is great. He's also written Influence, and there's a speech by Charlie Munger, I think it was to Stanford students back in the 90s, called The Psychology of Misjudgment, and he references Cialdini a lot. And he says, if there's one book I recommend you gift to your family and friends, he quotes something along the lines of, it's stupidity if you don't read this in your lifetime. So
okay, I didn't know that. I will either I say great minds think alike or fools seldom differ, but I wouldn't even joke about putting myself up with those guys at Berkshire Hathaway, so I won't. But it is a fascinating book. And actually, I think, Cyrus, it's the same book. I forgot, you're right, it's called Influence, The Psychology of Persuasion. So it actually is the same book. Yeah, so it's truly spectacular. Honestly, it's life changing. I try to read it every couple of years just because it's so well. It just gives you so many insights into us as humans.
Yeah. Well, Sean, thank you so much. If founders want to pitch you, reach you, or just generally anyone wants to reach out to you, what's the best way they can reach out to you? And do you have any final messages or anything?
No, thank you guys for having this. It's been a really enjoyable conversation. I joked that before we started rolling that we wouldn't be able to fill an hour, but we have, so that's great. It's been fun. I am always available at Seton-Rog, Setonrog on Twitter, Sean at profounderscapital.com. I'm easy to track down. I'm always happy to chat. It's my job. It's what I do.
Thank you very much for your time, Sean.